Hi everybody and welcome to the London session update with myself, Kathleen Brooks, on Monday the 18th of March 2013. Well, it's all about Cyprus today. Yes, we've got an FOMC meeting. Yes, we get the first reading of the PMIs from the Eurozone for March, but the focus is on Cyprus. Now, over the weekend, we heard that Cyprus, if it wanted to get a bailout, the conditions were going to be very, very stringent. In fact, it required a levy on all deposits held in Cypriot banks. So it was about 6.5% for deposits of less than 100,000 euros and nearly 10% for deposits of 100,000 or higher. We have seen, obviously, this is a very new direction for the bailouts. In fact, it's more of a bail-in than a bailout. However, the market reaction has actually been fairly muted. Let's take a quick look here. Now, you would think that the idea of bail-in, of private sector involvement and haircuts, when Greece was going through this process with its bank bondholders, the markets were going crazy. Now, there aren't enough bondholders in Cypriot banks for this to make a difference, so that's why they've gone the deposit route. But it is very kind of a new thing, and the fact of the fact that the bailout could potentially take people's money that's held in thing, and of course could fuel contagion fears, but that's not what we've seen. I'm going to show you that now. So let's take a quick look at this euro chart. This is a daily chart. As you can see, a very big drop. I mean, before the Tokyo Open, we were predicting 150-point drop, but since then we've actually based below 129, 128.70, and actually managed to find our feet around about 129.5. We're still holding on to that 130 handle. So why the muted reaction, I hear you cry? Well, actually, we've seen the bulk of selling in the stock market. So the bulk of selling has been in European stock markets, also in the banking sector in particular. Now, we saw Santander, a very big Spanish bank, that sold off over 3% at one point. It's found its feet, so it has been basing throughout the European morning. So it seems more like a knee-jerk reaction lower. Why not something more? Well, there's a few reasons. There's still a lot of unknowns in this bailout, about this bailout process. Number one, Cyprus still has to vote on whether or not it's going to accept it. Now, if it accepts it, we think the market will just digest this bank levy and just move on. Second, but if they don't, then Cyprus will be facing bankruptcy, and we think that could cause another wave of volatility. So it could be a very interesting time for the market. Now, some people say, obviously, we're worried about contagion fears. Let's see just how big those contagion fears are and how the peripheral bond market is reacting to them. Well, this is a spread between Italian-German 10-year bonds and Spanish and Italian 10-year bonds. As you can see, since the summer of last year, they've been falling very sharply as stabilization has been taking over and fears have reduced. They have ticked higher on this Cyprus news, but they're nowhere near at the levels that would suggest danger, or that Italy and Spain were in any particular, were in the grips of contagion from what's going on in Cyprus. Now, there are some reasons for that. Cyprus could be considered a special case. Firstly, it's got a very low corporate tax rate, so maybe Germany is a bit concerned about giving bailout funds to a country that has a much lower corporate tax rate than itself. It may find that a bit unfair. Secondly, Cyprus has got a bit of a reputation for money laundering, also very lax financial regulation. So that may be another reason why Germany and co in the northern bloc have been very strict with their conditions for Cyprus to meet this bailout. Now, we tend to think the parliamentary vote, so remember, as I said, Cyprus has to still vote to accept this package. Now, it has been delayed twice already. It was meant to take place yesterday, it was meant to take place today, and now we're being told it will take place tomorrow. We don't know the outcome of this vote yet. We don't even know the details really of it. We think that reaction, once we do know, could cause some market volatility. But right now, the market seems to be digesting what it's taken. We wouldn't be surprised, though, if we could see another flare-up. So, for example, if we get kind of more bankruptcy there in Cyprus, and that could open up the prospect of breakup risk in the Eurozone. The other thing, of course, the market's maybe a little bit too optimistic about, because essentially Spain and Italy, yes, they might be different cases to Cyprus, but they are very, very large. And bail-ins are probably going to be, so this is kind of depositors taking a hit, other kind of taxpayers in the domestic country taking a hit. Could be kind of a feature of bailouts going forward, say more the bail-in rather than the bailout, because there's just not enough money in those bailout fund pots. So this is a crucial moment for the Eurozone. The markets are digesting it, not reacting to it yet, but potentially they could lead to some real huge actions. And euro dollar, as we showed you before, 131.20 still seems to be resistance in the medium term with 128.80. So we think we're still going to trade in that range, but we are at risk to the downside if we get a no vote in that Cypriot parliamentary debate in the next few days. Okay, everyone, thanks for joining. Please do join us tomorrow for more.